Now, India's GDP growth for the July-September quarter came in at just 5.4%, marking the slowest pace in 7 quarters. This starkly contrasts with earlier expectations, raising concerns about the country's economic outlook. The slowdown is more significant considering that India had been projecting a much higher growth rate for this period. The 5.4% growth is not just a disappointing figure, but also poses a challenge for India's central bank. The RBI had previously forecasted a growth rate of 6.8% for Q2, but with this unexpected dip, the central bank now faces a tough decision. It can signal a shift in monetary policy when it announces its next move in December. A major factor contributing to this slowdown is weaker than expected corporate earnings, especially from key sectors like metals and oil and gas. Government spending, particularly in infrastructure, has also lagged behind expectations, with central government capital expenditure falling compared to the same period last year. Now, this sluggish investment, coupled with rising revenue expenditure, particularly at the state level, points to broader fiscal constraints. With the economy underperforming, the RBI may be forced to reconsider its growth projections and adjust interest rates to stimulate the economy. However, the central bank must tread carefully, as too many rate cuts could lead to inflationary pressures, complicating its policy stance moving forward. India's economic growth is now at a critical juncture. Now, to discuss more, we are being joined by Mitali Nikor. She is an economist and the founder of Nikor Associates. Thank you so much for joining us this morning. Let me just begin by asking you, what are the key factors behind India's unexpected 5.4% GDP growth in Q2?
So good morning, and thank you for featuring my views and the analysis that Nikor Associates keeps doing on India's macroeconomy and also on the overall global economic monitoring that we do. So when we look at, India's economy for the last quarter, what has been the real growth decelerator? Normally we say growth driver when we're decoding the numbers. So when I looked at it, essentially the manufacturing sector is the one that showed almost like a breakout star in 2023. But in 2024, that's where the massive slowdown has happened, because in 2023, we saw that for Q2, manufacturing sector actually grew by 14%. But this year, the manufacturing sector has fallen by almost 2 to 3, to a growth of just 2 to 3%. And that's been the main sort of decelerator. Apart from that, of course, private sector investment, the gross fixed capital formation, as we say, has slowed down. But there are green shoots, because the services sector, the agriculture sector, and private final capital expenditure, that is, basically consumption expenditure, that has gone back up, from what we saw, the levels we saw in Q2 2023. So essentially, a slowdown in manufacturing, a slowdown in private investment, also a slowdown in government spending these quarters are the main reasons why we are here today.
Right. Now, that being said, how do you think the Reserve Bank of India will approach its upcoming monetary policy announcement in December?
So if you recall, a couple of months ago when the Reserve Bank had the Monetary Policy Committee meeting, they went and they said that they're going to take what they call a neutral stance, sort of saying that, we need to look at where the trajectory that inflation is taking versus the trajectory that's being taken by growth and employment. And it's fairly evident that growth is, of course, slowing down. And one of the major reasons, as we've said, is this entire push towards investment. I mean, the economy, the government at this point in time, putting all its, focus on bringing manufacturing investment to India from all over the world. So I think the writing on the wall is clear. There has to be more of an action towards restarting that manufacturing cycle, restarting the investment cycle, and for that, interest rates have to be lower.
Right. Now, before I'd let you go, if you could just tell us about what implications does the lower than expected GDP growth have for India's long-term potential growth rate?
So I don't think that this is going to actually have that much of an impact on the long-term potential growth. I think this is a cyclical effect that we're seeing. We saw a lot of announcements in 2023. We saw a lot of investment coming in 2023. So we see a slight slowdown in this year, and it's not like we're not seeing growth. We still see some growth coming in. And also other industries, if manufacturing slows down, we see agriculture is recovering from 2.5 to 3.5% growth. We see services sector is recovering from a 6% back to around 9% growth in this very quarter. And also it's the quarter which was just post the elections, and that's when government spending was still restarting. So I don't think that this is significant from a long-term perspective. It's not signaling a long-term slowdown, but yes, it does signal that in the current cycle the interest rates are starting to get too high for the private sector to come and invest. Whereas at the same time, inflation is now currently quite stable at around 4% and very much within the RBI limits. So therefore, I do think that now the conditions are quite ripe for the RBI to consider, a rate cut.
Right. All right. We'll have to leave it at that. Thank you so much, for joining us. Mithali Nikor, she is an economist and the founder of Nikor Associates. Thank you so much for joining us this morning and giving your insights.
Thank you.